Okay, so this chapter, it's not quite as dry as the last couple chapters. There's a little bit more to it, and I actually have a few things that hopefully we can look at as examples, and then we'll end tonight talking about your ethics that you're going to work on next week when we're not here. Okay, so we'll kind of talk about how the next couple weeks are going to play out. So audit risk. So one of the things that when you go out in the audit field, before you have a med health or anything like that occur, is you have to look at what is your risk of finding any material misstatement. And remember last week we talked about what material misstatement was, and we said the word materiality meant what? Significant. So some type of significant misstated area. Okay, so depending on what we're looking at, that's what we're looking at. So the auditor is going to see that risk of some type of significant misstatement or departure from GAAP. So that's what we're talking about here. So we must have sufficient audit evidence to reduce that risk of any audit. So when we go out on the audit, one of the first things, or even before we go out on audit, is to figure out what is going to be our risk. What's our risk level? And so like when I was at Mallinckrodt, one of the things we did in determining which sites, now there we're doing internal audits all the time versus external audits. And so we had the financial team and we had the IT team. And so I built a database using Access where we would open it up and all of the sites and all the different locations around the world would enter information that we wanted to know about that site. And I used to have it for the longest time to show people, but that was, I left Mallinckrodt in 2000. And so it's no longer even anything I can even open and access anymore. But on the financial side, it just asks for things like, what's your total revenue? How many employees do you have? What's your accounts receivable? What's your outstanding debt? What's your allowance for doubtful accounts? And it went down and asked. It asked, how many people in your accounts payable? How many people in human resources? And it just went through and asked a whole bunch of different questions. Then it asked different things about segregation of duties. And then it asked questions about their shipping, because obviously Mallinckrodt has different areas. They had their pharmaceuticals, they had their nuclear, we had their, can't think of the respiratory, and so we had those divisions. So they all filled those different areas in, and then on the IT side, we asked questions as well, and we're going to have a whole chapter on IT here, but we said things like, okay, what systems are you running? They filled those in. How many people do you have in your department? When's the last time you did a backup? How often do you do backups? How many users had super user access? And we go through and ask those questions. And then, depending on what their answers are, we ran an analysis. Based on that analysis, we would decide what the risk was at that location. And one of the other risk factors was, what was their audit last time? What was the outcome of their audit last time? Did they have issues? If they did have issues, did they clear up the issues within a couple months after, 6 months after, 1 year after? Because if they had a bad audit, they automatically got audited the next year. So they automatically got put right back on. But if they then had a good audit, they were taken off and they might stay off for a year or two or a 3-year rotation. So that's how we kind of determine audit risk. But when you go into a brand new client, you don't have that same ability. So you have to go in and you have to ask those questions. And think about it, if you're going in as a new auditor. Hey, it's not me. That's okay. It's not me. That's okay. If you're going in as a new auditor and you're asking the questions and they are committing something that's not right, are they going to tell you? No. So you have to ask questions that are going to lead to areas that you're going to be able to hopefully tell if you can lead to other questions. So you have to ask the right questions. So you have to find the right information. All right, so a couple things on the financial statements. So a financial statement assertions, I have a hard time saying it, okay. These are with regards to controls. So we want to look at the account balances, about the class of transactions, all right, and events that are going on, and then the presentation and disclosure of those transactions. How are things done? How are things set up? So when we're looking at those that are relevant, how are we going to look for material misstatement and how everything is laid out on their financial statements? So here's some auditing standards and different international standards. So we have accounts, we have transactions, and we have disclosures. And you're going to see some of these words over and over again. So for instance, existence, rights and obligations, completeness, valuation and occurrence, all those occur, but they're different and they're more prevalent under different types of things. So for example, under accounts, we got, do the accounts exist? Is that something we can test? Yes. Do the accounts, do we have the rights to those accounts? Are the accounts complete? Do we finish the journal entries? And do we have the right valuation? Are they valued at the right amounts? Those are all things we can test for under the accounts. Under transactions, did they occur? And what we're looking for there is, did the transaction actually occur, or was it a fraudulent transaction? Was the transaction complete? Was it accurate? Right? That seems simplistic, but are the dollar amounts right? Was the cutoff right? There we're talking about a very easy test that many of you probably already heard about, but it's still the one that's done all the time, and it's sales cutoffs. At the end of the fiscal year or the end of the fiscal month, if you make the sale on December 31st, you have to sell or get rid of the item that's on the sale of December 31st. And you can't ship it if you didn't sell it. And those two things have to match up. And for some reason, everyone doesn't like to match them up. They sell, yes, we made the sale. Why? Because bonuses a lot of times are based off sales, right? So they push that sale in to December 31st or September 30th or whatever the year end is, but you go out to the warehouse and guess what? It's sitting on the loading dock. And in financial accounting, you learn that if it's sitting on the dock, it's still yours, right? It's not gone until it ships. And even then, sometimes it's not gone. It depends on how you're shipping it. So sales cutoff is something that's tested that just to me, and I was more IT audit than financial audit, and to me that's just something everybody knows going through accounting is sales cutoff, but yet still they do it all the time. There's very few audits at most companies, now they don't keep doing it, but that you go to the first audit that you don't find that. And you're like, really? But, it's a very basic one. And then classification, are the accounts put in the right places, right? Disclosures, did the disclosures occur? Do they have the rights? Same thing again, rights and obligation. Are they complete? Are they accurate? And then on this one, you have classification and understandability. So those are things, they're very common. Notice completeness exists on all of them. Because you're looking to see, did it go through from the beginning to the end, and is it accurate from that standpoint? All right, so then they talk about, how they use it in this text. So just kind of the wording of it, which I kind of just did this, so I'm not going to read through this. We kind of just talked about what they mean. But this is up here in case you need to go back through, especially if you're looking at homework or you're going through anything, if it comes up with the ethics or the litigation case that you're going to be looking at. There's more of the definitions that we just talked about. Okay, there's 3 different types of risk when you're actually in the audit, when we're talking about audit risk. Inherent risk, control risk, and detection risk. Okay, inherent risk is the risk that material misstatement's going to occur by having no internal controls. Right? To me, that's the one that's going on whether you're coming in and doing the audit or you're not doing the audit. Right? They have no internal controls set up, and therefore that's the risk that's having. Control risk is a material misstatement that's basically you're not going to, that material misstatement is going to be detected by not preventing it on a timely basis. I can't talk very well. All right. So this is basically you don't have a control in place to detect it in time. So it's a little different than inherent. And then detection risk is a risk that the auditors will not catch it. So that one's different than inherent and control. Okay, detection risk is a risk that the auditors will not detect or conclude that there's a material misstatement. So basically, I'm going to say the audit was fine, when in fact the audit was not fine. So that one falls on the auditor. So you can kind of see up here where the arrows fall down, risk of material misstatement, inherent and control, those two go together. They're more on the company side, but they're still what we're looking for, but they're on the company side. Risk of auditors not to detect is detection risk. because we're actually finding it then after the fact. And that's not the way you want to find it. I talk about it in financial accounting. The best way, when you're looking at risk, you want to prevent it from happening instead of detecting it from happening. But by the time the auditors come in, we're detecting it, because we're not preventing it unless they hire us to come in and set it up ahead of time. And then this is just in your books, and when you're looking at things, I think they're pretty basic abbreviations, but they're showing you the abbreviations when you're looking in the book. And I like this little formula. Gives you the little flow chart. And the thing I like about it is the best is basically this down here. The misstatement detected by the auditors is basically you're failing is the words that they use. So it's not always used in a lot of textbooks, so I kind of like it. Basically, we just failed at our job, whereas at the top, misstatement occurs on the client's part, misstatement was prevented or detected by controls, and bypassed by client controls, and then we failed by not detecting it. One of the things that was in your books, and I kind of went by it, but I want to go back, it was just a case that was on page 151, and it talks about the income statement of a company, National Student Marketing Corporation, and they talked about how they had total gains of $370,000 from the sale of 2 subsidiaries. And that those 2 subsidiary companies, they sold to 2 employees of the subsidiaries. So they sold the 2 subsidiaries to employees of the subsidiaries. The consideration for the sale was a note receivable collateralized by shares of stock. And it says, because both subsidiaries had been operating at substantial losses, the independent auditors obtained written representation from 3 officers that there were no identification or repurchase commitments given to the purchasers. All right, so that's what the auditors did on their end to basically say, I'm looking for my detection risk. I got these 3 letters saying that there was no repurchasing or identification or commitment given on the purchase. And the SEC actually went back and criticized the auditors for relying too heavily on management's representation regarding the sale. The SEC considered the sale to actually be a sham, and the transactions that would have been brought to light had the auditors actually sufficiently extended their audit and done better audit procedures. And they went on to say that the NSMC had executed various side agreements to assume all risk of ownership after the sale of one of the subsidiaries and had agreed to make cash contributions and guarantee a bank line of credit for the other one after the sale. Further, the NSMC stock collateralized by the note receivable had been given to subsidize the purchaser by officers of the company. So basically, the sale should have never happened. It was kind of an inside sale collateralized by other officers inside the sale, but the auditors didn't research it because they thought it looked okay, and they got 3 written letters of or written representation from 3 officers that there were no errors. And the thing is, this was done, there wasn't a date, but this book was written like 2 years ago. And in financial accounting, I actually show several videos that are from the 80s, but they're so good. Regina Best is in here, and we might have time to talk about it. ZZ's Best is a carpet cleaning business, which I talked about in class, and Kat had me. And I show it, even though it's from the 80s, because it's just, it actually captures my 18-year-old guys, and they actually watch it, because it's about a 16-year-old who started a carpet cleaning business in his garage, okay. And he started a carpet cleaning business in the garage, which at the start was actually a carpet cleaning business in his garage. And by 18, he was on the cover of Time magazine as this boy wonder. And then by 19, he was a millionaire, and at 20, he went public. And the reason he went public was because he was so far in debt, the only way to save himself was to go public. And he actually then ended up trying to do restorations, but they were all a sham. But he did that because that was his way of trying to then funnel other ways of telling the auditors and his stockholders that this is where money was going, and borrowing money, and as he was saying, borrowing from Peter to pay Paul. And he had the house, and he had the car, and he had all these things. So everybody thought he looked great, but his house was leased, or he said mortgage to the hill. All of his cars were leased. And he said, so he played the part of a rich person. But when the auditors did the audit, they talked him out of calling the banks. They said things like, if you call the bank, they're going to think something's wrong, and they're not going to want to lend me money. No, they're going to think they're doing their job. But the auditors believed him, and they didn't do it. When he went to dinner with their wives, and like they took out this 18-year-old boy, this 19-year-old boy, and the wives and the husbands, they all go out to dinner together, and they'd be like, but he's such a good kid. So as soon as they'd be like, I don't know, the auditors, this kid kind of gives me this feeling like maybe how could he be doing something wrong? Look at him, he's 18 years old, he's such a sweet kid. They'd talk him right out of it. They didn't look at his restoration bills. His bills for $3.5 million restorations were on one piece of paper with no details, no wages, no inspections, nothing. And the largest restoration to date, if I remember correctly, was something like $2 million. But he was doing $3.5 million restorations. And in the first year of his business, he had 0 accounts receivable, and the second year it jumped to something like $2.5 million. But no one followed to see was he actually collecting any money, because 99% of his accounts receivables were false. Because the restoration was 100% false, only thing that was real was the carpet cleaning, and it actually was losing money. And he was actually turned in by a housewife who complained about her bill. And what they would do on the carpet cleaning side is, you got to remember, we're back before computers, right? Back before you could check on your Visa bill all the time. And they would charge more for your bill than what they said. And then when a customer called to complain 30 days later, right, when you got your bill, they would say, okay, sometimes they would change it, sometimes they wouldn't change it. They didn't change hers, so she called and complained again. Well, back then, a lot of times you'd just forget, because now it's 60 days later on your Visa bill. She called again, they didn't change it, and she went to the press. And that just opened it up. And I tell my kids when they're in the class, I said, if he would have just flown to like Tahiti or somewhere at the age of 20, or some non-extradition country, he would have been fine. But like normal people who commit frauds, they don't think they're going to be caught. And the other things the auditors did wrong is they took photocopies. Auditors should never take photocopies. You should always take actual documents. And that's happened to me before, and I honestly believe at the company I went to, they were not trying to do a fraud. They were just trying to get us out of their way. So when we got there, they're like, here's a copy. I pulled 25 invoices for you and made copies. Here you go. And we're like, first of all, we have to pull them, and they can't be copies. And they're just like, oh, you're going to be bugging me all day. So, but you have to see the real one, because you can make, just like they did in the ZZ Best, they changed the photocopies. As they said in the movie, they were manipulators of the copy machine, master manipulators of the copy machine. They were really cheesy, actually, but manipulators of the, and if you saw the movie, you know what I'm talking about. They were extremely cheesy. But it was also the 80s, so probably in the 80s they weren't cheesy, but looking back at it, and the computers were, they were that big, sitting on the desk and everything, so it's kind of funny to go back and watch. All right, so going back now, so that's our side from the auditors. So now if you look at the inherent risk, this is the stuff that you have to picture, and you have to try to figure out, because this is the company. Now, if it's the first time you're going to a client, it's really hard. And so, like at Reuben Brown, the first time we'd go to a client, we'd go up there and we'd meet with them. We'd talk to them, even before we'd accept the engagement. You'd talk to them, you would meet with people, you walk around, you kind of get that feel, because there's different feels. When I went to Pulitzer, which is who owns the Post-Dispatch now, and they own a whole bunch of smaller papers, we went up there, it was a great feeling, right from the very beginning. But when I went to several clients, like ESCO Technologies down in Texas, as soon as you walked in, you're just kind of like, oh, this is going to be a really fun week. They just didn't want you there. They were also in bankruptcy, so there was a lot of other things going on. So you go in, and you got to find out the nature of the client and the environment. Well, guess what? If you're filing bankruptcy, what do you think the nature of the environment's going to be? All right, why are they filing bankruptcy? Well, you got to kind of figure that out. And then what nature of the particular financial statement element. So, you know, you got to figure out, okay, what's the accounting department set up like? How many people are in the accounting department? Who do they report to? And then basically the characteristics that would make the inherent risk higher. Okay? Your first thing you want is you want to go in and be like, wow, I think risk level is going to be low. Not, wow, I think the risk level is going to be high. You want to go in. So, inconsistent profitability, or they're bankrupt. All right? So as soon as I go in and they're in a bankruptcy, guess what? Their inherent risk just went up a lot. All right, operating results are sensitive to economic factors. They have a going concern problem, aka bankruptcy. Large and likely misstatements detected in previous audits. So anytime you have a unqualified opinion or any negative sort of any audit, even if it's a piece, you know, you can have a unqualified audit for the most part and have a qualified section. You got to keep your eyes open. And then substantial turnover, questionable reputation. You got to remember, when a company has turnover, a lot of turnover, there's a reason. Right? The only places I've went and worked, and I've had, counting this one, 5 different employers. The only place I went where there's high turnover, and it's supposed to have it, is public accounting. All right? You go there, usually young. I did it backwards. But you usually go when they're young, right out of college. You work there 2 or 3 years, and then you know you're either going to stay or you're going to take the experience you have and probably go work for one of the clients you just worked for in the last 2 or 3 years. But you're supposed to leave. Because if everyone stayed, they'd have a problem. Because everyone cannot become a manager and cannot become a partner, and you don't want to stay. You can't work those hours as a staff as you get older. So that's the only place that after 2 or 3 years you're supposed to keep going. Other than that, there should not be substantial turnover. When you see substantial turnover, you got to ask yourself why. And if it's due to one person or 2 people, then you got to ask yourself, what's that 1 or 2 people doing? Is it just they're not fun to work with? Or is there other things? And a lot of times people that aren't fun to work with, there's a reason they're not fun to work with. So then you kind of got to figure out what's going on behind that. All right. And then what's involved? Okay, well, does it make it difficult to audit the transactions? So do those risks make it harder to audit? What is the risk? Are you going to have a hard time pulling the transactions? People that are difficult to work with make it difficult to get things. Not because they can't do it, but because they just won't do it. They come in late to work, they leave early. You're there for 2 weeks, they decide to take a week off. They make it really hard. I mean, and I will be honest, I think I said this last week. People don't like financial auditors. And they don't like them on the internal side. When I was at Mallinckrodt, they didn't like the financial auditors either. They loved the IT auditors because we got them new computers. All right, whenever we went somewhere and we found a problem, they got new computer systems. So they loved us. Even on the external audit side, they liked us better than the financial people. I can't even tell you why exactly. They just don't like financial auditors as well. But when you go, they find reasons they don't want you to be there because they, in their head, it's a bad stigma that you're being audited. All right. There's complex calculations depending on what you're auditing, especially if you're going in maybe like doing a pension audit or something like that. Difficult accounting issues, pension audit. Significant judgment by management. All right. You get into some of these, if we talk about the Enron. And I don't have my notes. I'll try to remember to bring them next time. When I heard the CFO from Enron speak at the ACFE convention, one of the things that he said at the very beginning was when the whole thing started, it really wasn't fraud. The first thing that he did, I don't want to completely misspeak, but I believe it was some type of movement of expenses to like liability. It was some type of movement like that. It wasn't illegal, but he stopped himself before he did it. And he thought to himself, should I do this? And then he did it. And then they did it again. And then other things did become fraud, obviously. But he said when he was talking to us, and he was not your typical fraudster because, I mean, he was up there crying. And that's not your typical fraudster mentality. He said, if you ever have to stop and ask yourself, should I do it? Whether it's legal or not legal, you shouldn't do it. And he did it anyways. And he said, so that just started a path of things that happened. So when you have significant judgment by management, management made a judgment call to do this, and it started a path of bad things, as we know. And then valuation based on economic factors. All right, when you have valuation like that, there's valuation and litigation is its own department at Reuben Brown, and that was not a department I was in. But they amazed me how they would come up with different things and how they'd value different things, and they'd go to court and stand up and, when, not divorces and stuff like that, but like a business would burn down, and then they'd have to rebuild, but it wasn't their fault. And they would have to figure out, our accounting area would figure out in that department how much money that business lost by being down for that period of time, and what they could have gotten going forward if they would have been in business for that month that they lost by losing the new customers that they didn't get during that time. I mean, to me, that's just a whole different thing. All right, and then we got different transactions when you're out there doing the audit. You got routine transactions. Okay, those have a very much lower inherent risk. So when you're doing an audit, we have different levels of testing. So we would have what we call samples, and we're going to talk about sample in a few weeks. But so something that happened every day, it'd have a lower risk, we'd take less samples. But at the same time, even though we'd taken less samples, and a lot of times we'd take more items, but less risk behind it. Meaning, okay, it happens every day, let's take a sample of 32. But if 2 fail, that's okay. The risk isn't that big. Non-routine, something that occurs only periodically, such as taking inventory. So we go and take inventory, that's a much bigger risk. So if we go out there and look at their inventory count and we find problems, that's going to be a bigger problem. They only do it once in a while and we found a problem. What would happen if we did it more often? We'd probably find more problems. And then estimated transactions, that's a much higher risk when you have to do estimation. And there's a little bit more of that we'll talk about in a second. So what's the appropriateness of audit evidence? All right, so first of all, it has to be relevant and it has to be reliable. When we go in and we look at things, everything has to be relevant to the period that we're looking at, and usually that's a year. When we go out and we looked at things from Brown, everything would be in the last calendar year, but when we did samples, we would pull from the last year, but we'd also kind of look at that last 6 months. When I looked on the IT side, I would always pull terminations. Terminations would be in the last 6 months because that to me was usually more important. However, when I did backups, I would do a year, 1 month, one backup from every month for a year. When I did daily backups, I didn't need daily backups going back for a year because I just tested monthly backups. I don't care about a daily back. Daily backups, I only really needed the last one a week for the last month. Are they happening on a regular basis? So you got to look at what you're looking at. Are they relevant and are they reliable? If I went out there and tested every month's backup and every weekly backup and every yearly backup, I'm doing overkill. And if you go out there and tested every sales transaction for every week and every month, you'd never get your audit done. All right. Principles of, okay, so basically, you have to look at where did you obtain it from. Remember how I said no photocopies? All right. Where did you get the audit evidence? You need to go to the accounts payable person to get copies of the accounts payable documents. You can't go and see somebody who's in the accounts receivable department who says, oh, I got these from Sheila. She gave them to me. You need to know that you got the information from the right people in the company. If you're looking for outside knowledge, like if there's a third-party company that's working with them, which on the IT side, a lot of times we got to go see that third-party vendor, then we got to actually go talk to the third-party vendor. Just talking to the company saying, oh yeah, we have agreements with them. We got to go talk to them. You got to talk to the people that have the knowledge. There are some things that nowadays you really have to go through the computer to audit. And you got to look at those systems. Oral documentation is okay, but written documentation, it depends. You got to kind of have a combination of both. Sitting down and talking to somebody a lot of times gives you more information than something that's on a piece of paper. So there's something called narratives. You don't do them all the time. Like if you have the audit year after year, you're just going to update your narrative. But if you have, first time you go, you're going to sit down and you're going to say, how does your process work? And they're going to tell you. You really can't go test that process until you understand how it works. and that's through oral documentation. And then we all already talked about the original documentation. And we're going to talk about this in the IT, but when you, right here, under generated internally through a system, that's really important because the company that I mentioned that I went to in Texas that was in bankruptcy, one of the things that happened when we were down there was that the financial people came to me one night at dinner and they said, hey, when you're looking at the systems tomorrow, they ran J.D. Edwards, they said, can you check, they said they had the three-way match turned on. And this was kind of relatively new, especially for us and the financial auditors. And I said, okay, and they said they're using that. They're not matching the invoices, the PO, and the shipping documents. They're letting the system do it. I'm like, okay, no big deal. So the next day I went in, that wasn't turned on. It's literally at the time, I don't know if it still is, in J.D. Edwards, a yes, no. Like click, not click. It wasn't turned on. They'd been running J.D. Edwards for over 2 years. And so the accounting area, that department, had not been validating or verifying that the shipping, purchasing, ordering, and invoice were matching. Nobody had been doing it. So they were just paying every invoice. Now, they were in bankruptcy. So was it because they were just paying every invoice, or were they being lucky? You know, who knows why they were in bankruptcy. But you're relying on I already changed the slide. You're relying on internal controls to do things for you. You've got to make sure they're working. You got to make sure they're turned on. And I'm not blaming their IT department. More than likely, it was set up by somebody from J.D. Edwards that came in and turned it on. I'm not saying it was their fault. Somebody might have not told them to turn it on. I don't know where it happened, but it was not working. So if you're going to go in and you're going to audit, and you're the financial auditors, and you have them tell you something like, oh, it's being tested through the computer, it's now your job to go tell the IT auditors, if they're there, to test it. If you don't have any IT auditors, then you got to figure out a way to go look at it yourself. Because you just can't say, okay, because just when they say it's being tested through the computer, that does not mean anything is done. That's like saying, yeah, I'm changing my password every 40 days. You can go in there and change that to never change your password if you have the right access. So anything can be changed in a computer. So as soon as they say that's being done through a computer, it always has to be tested. And companies are very strange. They do audits, but they still all don't do IT audits.
But did they, when they were, so the person who's paying, like I do the bills at
Right.
my company. I mean, I always call the people, did you get this? Oh yeah, we received it.
They were set up through a three-way match system that they were told that the shipping document, the purchase document, the PO, and the invoice were all being matched, and they would not receive the invoice. How J.D. Edwards is set up is the invoice flows through after they've been matched and validated. So they shouldn't have been receiving an invoice to be paid like it comes through J.D. Edwards to be paid.
Shipped, so they got it.
They got it, and then the shipping or the invoice or whatever it's called from the doc, we got it.
Yeah.
All those came through, and then they paid it. And nobody in accounting, it's not your job to say, wow, we're getting everything of every invoice. But that's not an accountant's job to necessarily notice that. And they're in a different field, so maybe you do get everything in that field. But, you know. All right, so different risk assessment procedures, okay? Basically, understand the environment, understand the internal control, and assess the risk for material in the statement. It sounds really easy, but everything we just talked up through now, that's what risk assessment procedures. There's a lot of things in that. Understand your environment. That's called tone at the top, and we talked about that last week. If you don't understand what's going on with management, then you're not going to understand the environment below management, because that tone sets the stage. We kind of laugh about it here, but it sets it here too. Our tone is the chancellor and the vice chancellors. And our chancellor seems to rotate a little bit around here, so our tone changes quite a bit. So when you have a lot of change at the top, then your tone at the top is constantly changes, which makes your internal control and your risk assessment go up. If your tone at the top is always changing, your risk is going to be higher. Yeah?
How do you decide how much it goes up, like percentage-wise?
Well,
Or how much to assign to each procedure goes to each
That's when you're going to have to go and you're going to look at their internal controls, all right? And you're going to see how strong their internal controls are. If they have strong internal controls, that's going to help you keep the risk level down. But if you go in and they don't have very good internal controls, to me, one of the most important internal controls of your 5 is segregation of duties. I mean, to me, because if you don't have that one, the other ones aren't as important. I mean, because you can have document procedures, but if everybody can do whatever in the heck they want to do, it doesn't matter if you document your procedures, and it doesn't matter if you do independent verification. If everybody can do whatever they want, they can go and change whatever verification they want. So you got to go in and you got to look at that. And one of the first things that Reuben Brown always did is they sent out this little grid, and I wish I had it, that kind of had the jobs across the top and the counting and the people down the bottom. And you went in and said who did what, and then you sent it back, and there were boxes that grayed out. And if you put, for example, Marcia here and Marcia here, those two weren't supposed to be the same person, it's going to be grayed out, and that's going to be a flag. But they don't necessarily know that. You just send them the spreadsheet and say fill in who does what jobs, and then it comes back and it kind of gets overlaid in Excel, and then it's a flag right off the bat. But you don't let them know, because it's obviously if you send them that and it blacks it out, they're going to be like, well, no, we don't do that, and they don't put their name in that field. But that's one way. And that segregation duty goes out before you go, because that way it comes back and it helps you access that internal control. So the better than controls, the lower the risk. But all those things come in together, and that's one of the hardest things. And there's sometimes you go out to a site thinking it's a low risk or medium risk, and you got to extend your audit. You get there and you're like, this is a mess, or this was worse than I thought it was going to be. We got to add a couple days, and that's where sometimes you really got to, especially when you're charging, you're giving them a fee based, and sometimes you got to go in there and be like, you got to go right to your partner or your manager first, whichever level you're at. And you got to go and you got to say, we got to add 5 days. Why? And then you got to justify it, and you got to take it to the client. And where the client's got to then say yes or no is, you're telling them you're finding problems, and you're seeing concerns. So if they say no, that's not a good sign either. And then you're probably looking where you might give not a good opinion, or you might disclaim from the audit too. I mean, so that's where you might have to think about that. I've never been on an audit where we've gone in and said, we're having problems, and we got to extend it based on this, there's going to be more money, and had them say no. They don't like it. They complain. They complain to the partner. They didn't complain to me. So that's usually pretty good. When you need to extend the audit, you usually have the partner do it. That's why they get paid the big bucks, right? They only come once in a while to the site. That's when you call them.
We had an audit I worked at adult daycare. We had an audit, and the auditors came in and they saw who the business lady was, and they said, we're leaving. And they're like, why? Because she was caught doing other stuff at another company, and they said, we don't trust her at all.
And they didn't want to be a part of the
Yeah,
audit.
they're like, unless you get rid of her, we're out of here. The nun who ran it was like, oh, okay.
So did you get rid of her, or did you get another auditor? Okay.
Yeah, and then auditors came back and were like, okay.
Because think about that. So if the person that runs the adult daycare said, well, we'll get another auditor, would you want to keep working there? Or would you? Right, so I mean.
Because I was like, did you not, she wasn't good
She had no
about
idea.
calling references.
Oh.
And I was like, I didn't like the lady to begin with, but I was like, oh my gosh. I mean, right when they walked in and saw her, they're like, we know her. And I was like, oh, yeah.
That's right.
I was like,
Well, and
oh,
that's scary.
Yeah.
Yeah.
But the flip side can help you, because I've been in firms where the auditors walk in and they see somebody and they say, we like that person.
Right,
Oh, right,
yes.
yeah.
You've seen them around.
Right,
and-
and they're going to be helpful, right.
Yeah, they're one and two reasons.
Well, I can tell you, if you ever get an audit with Lee Enterprises, they were one of my favorite people. I worked for Reuben Brown for 2 years after I was teaching as a, quote, employee, but really a consultant, however you want to look at it. And I kind of joked they didn't accept my resignation, because they just I paid me hourly, but the only client I had was Lee Enterprises. And so I'd work on them. Their audit was in the spring, fall, and they were 4 hours away up in Davenport, Iowa, so I'd drive up there when I had to. I had the staff that did it. I reviewed it when I needed to, but I liked them. And that's the reason I kept doing it. And when I left, the person that worked under me became a manager, and he took it over. But I would tell anybody that you walk in there and have them, they're going to, especially on the IT side, they're going to do what they need to do to get stuff done for you. Now, they're also listed as one of the top 20 companies that might go under in 2017 because they're a newspaper. You know, they're a newspaper that's not Gannett. Gannett owns a television company, and they're a newspaper. Lee Enterprises is just newspapers. And so, unfortunately, newspaper, my husband still buys it, loves his newspaper, but newspaper is not not necessarily the business you want to be in if that's your only business that you're in. So, all right. Let me show one other thing, and then I want to look at something in the book. So then what do you do, kind of like what you were saying, what do you do as your further audit procedures? And so whether you let go somebody or, well, you have test of control. So that's our next step. Our next step is where we go in and we actually start testing. Once we evaluate, once we see what our environment looks at, we're going to go and we're going to test the controls that are supposed to be preventing. So on the IT side, I'm going to go test my J.D. Edwards control that's supposed to be doing our three-way match, right? I'm going to go in and test those. And then there's also substantive procedures, which we will talk about a little bit. Those are analytical procedures and test detail account balances and stuff like that, where we go in and look at a little bit more details on the accounts. So let's take a look at, see if I can remember the problem number. Let's take a look at problem 554.